So I have a lot of tabs to get through here, so I'm going to be talking very fast. There's a couple things we need to understand. We need to set the backdrop, and the argument that I'm making here is that crypto is undervalued compared to other asset classes at the moment, given the current macroeconomic circumstances. Two things you need to understand: 10-year Treasury note yields pretty much at an all-time low. Interest rates are extremely low. I'll get rid of that. They've printed a ridiculous amount of money. Now, there is a large gap in this chart because they changed the way they've calculated it, but they've recently, over the past year and a half, pretty much doubled the money supply. Now, if you did a stock split, or let's just say Apple did a stock split, right, and they doubled the supply of their issued shares, what would you expect to happen to the price? The price would be cut in half. The value of each share would be cut in half perfectly by 50%, and each person would get double the amount of shares. That's how a stock split worked. Well, they've just doubled the money supply, but you didn't get double. Your dollars didn't double. The number of dollars in your bank account didn't just magically double overnight, right? So they're devaluing the dollar. We've got inflation coming in. We've got inflation rising. Basically, nobody wants to hold on to dollars, and because of that, people are willing to buy value assets for a risk premium, right? So people are paying an excess amount of risk in order to be invested in stocks, equities, gold, silver, real estate, cryptocurrency, or they should be in the case of cryptocurrency. But I'm going to make the argument that cryptocurrency really isn't trading in a bubble. So first, let's take a look at Bitcoin. For one, if we subscribe to four-year market cycle theory, and there's two major theories when it comes to cryptocurrency market cycles. You've got the four-year cycle theory, which we've got outlined here. Each of these cycles between the dashed lines is 4 years. And the alternative theory is lengthening or expanding market cycle theory, which would say that each market cycle is growing in the length of time. Well, currently, we're at about 3.5 years from our last peak in January of 2017, or December of 2017 or January of 2018, right? In terms of Bitcoin, it would be in December, right? So we still actually have 161 days, give or take, left in this market cycle if we subscribe to four-year market cycle theory. When it comes to lengthening market cycle theory, we would actually have more time. How much more time? That's uncertain. Well, can Bitcoin make a large move, and can the total cryptocurrency space as a whole make a large move in the next 161 days? Let's go back to 2017, and let me remind you that Bitcoin ran from $3,000 to $19,700 in 91 days. The vast majority of the gains come at the end of the market cycle. The same thing happened at the end of the previous peak of the previous market cycle. So, with time left in our Bitcoin market cycle, or total cryptocurrency market cap space market cycle, is there time left on the clock for Bitcoin to make a massive move? Absolutely. Now, we can measure fair value a couple different ways. We've got logarithmic regression bands here, and I would say anything between the green and the red regression bands is fair value. Bitcoin is trading just under the red regression band, right? So if we measure fair value using these regression bands, Bitcoin isn't actually trading in a bubble right now. It recently was, but it's no longer. It's right on the edge of being in a bubble. But given the fact that the outgoing supply of Bitcoin just halved last summer, the halvening cycle, and the state of the market the state of the macroeconomic situation that I just explained to you, with interest rates being very low, right? And the fact that they just printed a ton of money, and people are willing to pay premiums over fair value for asset classes, and Bitcoin being a very, very solid store of value, we would expect Bitcoin to be trading in a massive bubble. Yet it's not trading in a bubble. And if we use the stock to flow model, one of the most historically accurate models for anticipating the fair value or measuring the fair value of Bitcoin, we're actually undervalued. The stock to flow model has us valued fair value right now at roughly $85,000. Yet Bitcoin's trading at $35,000. That is absolutely insane. So regardless of what fair value model we use, we're seeing that Bitcoin is trading not at a premium at all in terms of where it should be in terms of risk. Now, let's go to the total cryptocurrency market cap and let's look on a logarithmic chart. And I'm going to start flying through these slides, but there's one concept I want you to understand. We can measure fair value with a trend line because we're measuring the growth trajectory of this asset class, total cryptocurrency market cap, right? We have tons of data points along this trend line to suggest that this would be a conservative measure of fair value. Then we can take measurements in terms of days to fair value. That's where we're at right now, 406 days to fair value. That means if you invest now, you're paying a risk premium of roughly 406 days, right? We know that cryptocurrency is very early in its adoption cycle and it's got a very fast growth trajectory. So we're looking at 406 days if you invest in crypto right now to actually get to this fair value number. Now, obviously, we expect bubbles and deviations from this. We're not going to go straight into the trend line more than likely, right? Now, at the peak, our most recent peak in total cryptocurrency market cap, we traded at 728 days to fair value. Historically, the total cryptocurrency market cap has peaked roughly 1,463 days and 1,200 days from fair value. Now, that was without the current situation that we have with insanely low interest rates and very high inflation due to the amount of money that's been printed. One last thing before I start firing through these slides. Microsoft in 1999, towards the peak of its bubble, traded at a $600 billion market cap. One stock, $600 billion, right? Now we're talking about an entire asset class trading at 1.4 trillion, barely more than 2 times what one stock traded at in the tech sector in 1999 when there was 5 times less money in circulation. In fact, if we grossed and normalized this up for today's money supply and we 5x this market cap, that would be a 3 trillion market cap for Microsoft in terms of the amount of money that has been printed since 1999. That would be surpassing. That would mean that one stock in 1999, that bubble was larger than the total asset class bubble that we've seen peak at $2.56 trillion for crypto. Let's jump over to Ethereum really quick. Days to fair value against the trend line. If we use this yellow one where most of the data is at, 287 days, very close to fair value. Let's jump to the S&P 500. I've got 2 measurements, 2 trend lines. We've got a conservative one and a long-term one, right? In our more conservative one, the more capturing more recent data, we're almost 3,000 days away from fair value. That reads 2,830 days. That means you're paying a price that based on the S&P 500's growth trajectory, the S&P 500 shouldn't be worth this price until 2,830 days from now. So you're paying a 2,830 day risk premium by investing in the S&P 500 right now. And if we use our longer term growth trajectory of the S&P 500, you're paying over $5,000 in risk premium. This is what we'd expect. Is this a bad thing? Is it risky? Yes, but given the current circumstances with inflation, we expect people to be paying a premium, yet they're not paying a premium for crypto, or they're paying a 200 to 700 day premium. Gold, actually, you can make a very strong argument for gold because it is only 1,274 days away from its fair value. However, the drawdown for gold is very low, 17%. And that's actually why I believe our machine learning models at Token Metrics for our investor portfolios oftentimes recommends a small allocation around the 10 to 20% range for PAXG, right? PAXG is the gold pegged stablecoin, right? Let's look at silver, over 5,000 days away from fair value. Let's look at real estate, commercial real estate, 3,868 days away from its fair value growth trajectory trend line. Where was real estate in terms of risk, the last time it crashed, it was 3,500 days away from its fair value trend line before it crashed in 2007, 2008. We've surpassed that now. 3,868 days of risk. Residential real estate, 4,000 days away from its fair value. Netflix, 3,000 days away from its fair value. Microsoft, over 1,600 days away from its fair value. Even oil, which did have a recent trip down to the negatives, but now is over 5,000 days away from its fair value. Last slide, let me go back to total cryptocurrency market cap. 406 days away from fair value. Crypto is growing extremely fast, and while yes, there is potential for a large drawdown of up to 55% down to fair value, you get rewarded with investing in crypto with a much faster growth trajectory because it is a much smaller, faster growing asset. And that's my argument for why crypto is undervalued compared to other asset classes, especially in terms of the risk premium that you pay to invest in crypto.
Token Metrics is a cryptocurrency investment platform that helps users leverage machine learning to become better crypto investors. Our in-depth analysis helps eliminate the emotions of investing, find profitable investment opportunities, and filters out scams. Learn more at tokenmetrics.com.